So here is your turn to practice pricing term life policies based on what I've told you in a different video segment. So again, the information is based on a 35-year-old wanting to buy a 5-year term life policy, here with the face value of $25,000. The question is, what would be the premium, or what would be the price of this policy at right now for the 35-year-old to get activated? And for the purposes of solving the problem, we assume a discount rate of 2% annually. Again, the problem basically means what would be the value, or how much would it cost for this 35-year-old to buy this policy so that he or she is covered for $25,000, which his or her beneficiary would get if something were to happen to her between 35 and 40, the next 5 years. That's the problem. And you follow exactly the way we've discussed this in an earlier video segment. So what you need to do is to compute what would be the expected claims at each of years 36, 37, 38, 39, and 40. Take the expected claims, which are dollar amounts, discount them each back to time 35, which is the starting point in this case. And as I've said before, 35 is just an example. It could be a 30-year-old buying a 5-year policy, in which case we'd bring it back from 35 to 30. So it's all relative based on what the problem is telling you. And once you have the present value of those sums at the starting point, which in this case is 35, you simply add them up, because remember, it's perfectly okay to add sums of money at the same point in time, at 35 in this case, and that sum would represent your lump sum payment that is due at the starting point at 35 for you to be covered in full for a face value of the stated amount for the next 5 years. So that's the way you proceed to solve this problem. Now let's look at a variation that I introduced in an earlier video segment. That is, the challenge is that most people buy insurance policies not for $10,000 or $25,000, but for much larger amounts. So it could be $1 million, $2 million, $3 million, and so on. That's sort of more the norm than the examples that we've used so far. But it doesn't change anything. None of the discussion changes except the starting amount. The starting, obviously, with the example we saw in an earlier video segment, what we saw was for a $10,000 face value policy, the lump sum payment at the starting point was $107 and change. Well, while $107 is not a big issue, it does become a bigger issue when the face value changes from $10,000 to $1 million, right? That's a factor of 100, scaling that face value up. So if you scale the premium accordingly by a factor of 100, the $107.32 that we have seen elsewhere becomes a $10,732 premium, a lump sum premium that you have to pay in order to be covered for $1 million face value. That is a problem for most people. And if you're like me, I don't have $10,000 just laying around to pay on an insurance premium just in short notice. And therefore, that becomes a problem. And so what do? So usually what people do is that you make periodic payments. So for the next 5 years, starting at right now, the first payment being at 35 in this case, the starting point, if that's the starting age, you make a payment and then you make equal payments annually, and you are covered for the next 5 years with the first payment starting right now, which is different from standard annuity problems that we have seen so far, where the payments usually or payouts occur at the end of the period. Here, the first payment is occurring at the beginning of the period itself. That does complicate things just a small bit that we'll talk about. But that's the only thing that you have to keep in mind when you solve insurance type or premium type problems, is that the premium or either the lump sum or the first payment in an annuity stream, if you were to break it up into manageable payoffs, not the $10,000, but how do you break up that $10,000 into equal annual annuity payments that you will write a check for to the insurance company at the end of the year for the next 5 years? That calculation involves annuity, which is structured slightly differently, which is that the first payment has to be made right away at the point. So with that said, let us look at the example that we took from before, which is that the calculation, if you recall, the face value for $10,000, the premium, the lump sum premium was $107.32, right? $107.32. The question is, what if you were to break this up into equivalent annual payments? How much would those annual payments be, right? That's the question. So the way we solve that is the following. So here's a little handy dandy timeline that I've drawn, which is usually great for explaining time value of money problems. You can see that, think of these X's that are showing up on that timeline as those premiums, with the first payment notice is due at 35, which is right at the starting point of the policyholder. So X, 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 and X, with the last payment occurring at 39 for the 39 to 40 time period. So the question is, what are those X's? We have to solve for that equal X amount so that the present value at 35 is 107.32, which is that lump sum premium. So all we are doing in this problem is decomposing that lump sum premium present value into equal annual annuity amounts, which represent annual payments to the insurance company as premium payments. So in order to do that, all we do is we simply write out this left-hand side of this equation is the present value, which is the $107.32 that we should be all extremely familiar with by now. That equals the current payment that is due right at that point in time, which is that X. And then the rest of it is an annuity, right? So think of the 4 annuity payments of X occurring each at 36, 37, 38, and 39 represent a 4-payment annuity, right? And so if you take the X and then multiply that by the present value factor for annuity that we have seen in many different video segments, corresponding to the interest rate, which is 4%, and N equals 4 payments, the corresponding factor that either you can calculate using formulas that you've already seen, present value factor formula, or from a table, would be 3.6299. That's the factor value, the discounted factor, present value factor for annuity. So if you simply then manipulate this equation, you're getting 107.32 equals 4.6299 times X, and therefore when you solve for that X, you get the X would be somewhere in the range of $23, and that is something that you can work out, and that represents a much more manageable annuity amount that you can then work with. And so even if it's $1 million policy, it's really like a $200 annual payment to be covered for the next 5 years at a face value of $1 million. So you can see that by breaking up these lump sum into equivalent annual annuity amounts represents a much more affordable way to have insurance.